Ladies and gentlemen, stop what you're doing. Something just shifted in the Federal Reserve's operating system, and if you blink, you're going to miss the moment when liquidity becomes the most dangerous word in American finance. The Fed just released a new reserve schedule. That's what they're calling it, a schedule adjustment, a technical recalibration. But here's what they're not saying. This isn't about efficiency. This is about survival. Let me walk you through what just happened, because the surface story and the real story are not the same thing. On the surface, the Federal Reserve announced changes to how banks must report and maintain their reserve requirements. New timelines, new thresholds, new reporting windows. It sounds boring. It sounds administrative. But here's the part that should make you pause. They're shortening the cycle. Banks now have less time to balance their books, less time to find liquidity, less time to cover what's missing. Why would you shrink the window unless the window was already a problem? That's the question no one is asking. And that's the question that leads you straight into the center of what's actually happening right now in the American banking system. Because what we're watching isn't a policy update, it's a pressure release. And pressure doesn't build unless something is about to crack. Let me take you back 3 weeks. The Federal Reserve's balance sheet showed something unusual. Repo operations spiked, not by a little. We're talking about a $17 billion jump in overnight lending to banks that supposedly didn't need it. That's banks coming to the Fed, hat in hand, asking for liquidity to make it through the night. $17 billion overnight. And the media called it a seasonal fluctuation. But here's what seasonal fluctuations don't do. They don't require emergency schedule changes 3 weeks later. And here's what else they don't do. They don't cluster around specific institutions. And when you dig into the data, when you look at which banks access that $17 billion in overnight funding, you start seeing patterns. It's not spread evenly across the system. It's concentrated in 4, maybe 5 major institutions. The same names that show up in every stress scenario. The same names that hold trillions in derivatives, in mortgage-backed securities, and commercial real estate exposure. And these aren't small players testing the facility. These are the pillars of the system showing cracks. And the Fed's response wasn't to question why these banks needed emergency liquidity. It was to change the schedule so they could monitor it more frequently. That tells you everything. They're not fixing the problem. They're tracking it. They're measuring it. They're documenting the decline in real time because they know they can't stop it. So what's really happening? The reserve schedule change isn't about making things smoother. It's about making things faster. It's about forcing banks to show their hand more frequently because right now the Fed doesn't trust the numbers it's seeing. And when the central bank stops trusting the banks it's supposed to regulate, you're not in a policy discussion anymore. You're in a containment operation. Now let's talk about what reserves actually are, because this is where the story gets darker. Reserves are supposed to be the cushion. The money banks keep on hand to cover withdrawals, to settle payments, to prove they're solvent. It's the difference between a functioning bank and a bank run. And under normal conditions, banks hold more than enough. They don't need to scramble. They don't need emergency windows. But we're not in normal conditions, and the Fed knows it. Here's what happened in the background while everyone was watching inflation data and interest rate decisions. From January to now, aggregate reserves in the U.S. banking system fell by over $900 billion. Think about that number. Nearly $1 trillion in liquidity vanished from the system in less than a year. Some of that was intentional. Quantitative tightening, the Fed shrinking its balance sheet, draining reserves on purpose. But here's the problem. They expected banks to adjust. They expected liquidity to redistribute. They expected the pain to spread evenly. It didn't. What happened instead is that reserves clustered. Big banks, with access to money markets, with treasury operations, with global funding sources, they stabilized. Mid-sized regional banks, community banks, institutions without those built-in advantages. They bled. And some of them bled so fast that by March, we saw the beginning of what almost became a cascade. Silicon Valley Bank, Signature, First Republic. Those weren't random failures. Those were liquidity crises that turned into solvency crises because the reserves weren't there when they needed them. Here's the signal everyone is missing. Over the last 6 months, reserves in the banking system have been falling. Not slowly, not gradually. We're talking about a steady, measurable decline that accelerated in the last quarter. Some of it is due to quantitative tightening. The Fed has been pulling liquidity out of the system on purpose, shrinking its balance sheet, trying to fight inflation. That's the official story. But here's the unofficial story. The decline isn't happening evenly. It's concentrated. Certain banks are bleeding reserves faster than others. And those banks aren't small regional players. They're systemically important institutions. The kind the Fed calls too big to fail. The kind that, if they wobble, the whole system wobbles with them. And now the Fed is changing the rules for how those banks have to report their liquidity. Faster cycles, tighter windows. It's like a doctor who suddenly wants to check your pulse every 10 minutes instead of every hour. That's not confidence, that's concern. So where did the reserves go? That's the question that leads you into the real crisis. Some of it went to cover losses, not headline losses, shadow losses. The kind that don't show up on quarterly earnings, but sit in the footnotes of balance sheets. Rising interest rates destroyed the value of long-dated bonds. Banks that loaded up on treasuries in 2020 and 2021 are sitting on paper losses in the hundreds of billions. Those bonds are held to maturity, which means they don't have to mark them down. But if they need liquidity, if they need to sell, they take the loss. And selling means burning through reserves. Some of it went offshore. Capital flight doesn't always make headlines, but it shows up in the data. Wealthy clients, corporate treasuries, foreign investors, they've been moving dollars out of the U.S. banking system and into money market funds, into treasuries, into anything that isn't a deposit account. Because deposit accounts are insured up to $250,000. If you have $10 million, $50 million, $200 million sitting in a bank, and you start hearing whispers about liquidity problems, you move it fast. And the numbers confirm this is happening at scale. Money market fund assets just hit a record high. Over $6 trillion. That's money that used to sit in banks, earning nothing, providing reserves to the banking system. Now it's outside the system entirely. It's in government-only funds, in treasury bills, in places where there's no bank intermediary. And every dollar that moves out of a bank deposit is a dollar of reserves that disappears. The Fed can't control that. They can't force people to keep money in banks. All they can do is watch the outflow and try to manage the consequences. But here's the twist that makes this even more dangerous. When deposits flee and reserves drop, banks don't just sit there and accept it. They compete for what's left. They raise rates on deposits. They offer incentives. They try to pull liquidity away from each other. And that competition creates instability because the moment one bank offers a higher rate, every other bank has to match it or lose funding. It's a race to the bottom disguised as a race to the top. And the Fed's new reserve schedule doesn't stop that race. It just makes it more visible. And some of it just disappeared into the machinery of the overnight lending market, where banks borrow from each other to cover gaps that shouldn't exist. The fact that the Fed had to step in with $17 billion tells you those gaps are getting wider. Now, here's where the new reserve schedule becomes a weapon. By forcing banks to report more frequently, the Fed is trying to catch problems earlier. That sounds smart. That sounds prudent. But there's another side to this. When you force banks to show their liquidity position more often, you also force them to act more desperately. If a bank knows it has to hit a reserve target in 48 hours instead of a week, it can't wait for liquidity to show up naturally. It has to go find it. And when everyone is looking for liquidity at the same time, the price of liquidity goes up. That's when overnight rates spike. That's when the repo market seizes. That's when the Fed has to step in again and again and again, until stepping in becomes the norm instead of the exception. This is the trap. The tighter you make the rules, the more stress you create. The more stress you create, the more liquidity you have to inject. The more liquidity you inject, the less the system can function on its own. It's a cycle. And right now, we're in the early phase of that cycle, where it still looks like policy adjustments and technical fixes, but cycles accelerate. And once they accelerate, they don't slow down until something breaks. Let's talk about what happens if this continues. If banks keep losing reserves, if the Fed keeps tightening the schedule, if liquidity keeps getting harder to find, you don't get a sudden collapse, you get a slow squeeze. Banks start pulling back. They stop lending to each other. They stop extending credit to businesses. They prioritize safety over growth, liquidity over profit. And when banks stop lending, the economy stops moving. We've seen this before. 2008 wasn't a single moment. It was a series of moments. Liquidity dried up in the repo market. Banks stopped trusting each other. The Fed stepped in with emergency programs. And by the time the public understood what was happening, Lehman was gone and the entire system was on life support. But here's what people forget about 2008. The warning signs were there months before the collapse. Bear Stearns failed in March. Lehman didn't fall until September. 6 months. And during those 6 months, regulators insisted everything was under control. They had stress tests. They had contingency plans. They had new reporting requirements. Sound familiar? The difference this time is that the Fed learned from 2008. They learned that waiting too long turns a liquidity crisis into a solvency crisis. They learned that once confidence breaks, it doesn't come back with speeches and reassurances. So now they're acting preemptively. The new reserve schedule is part of that. The expanded repo facility is part of that. The quiet conversations with major banks about liquidity buffers, all of it is designed to prevent another Lehman. But here's the problem with prevention. It only works if you catch the problem early enough. And all the evidence suggests they didn't. The reserve drain has been happening for months. The concentration of stress in major institutions has been visible in the data since the spring. And the outflow into money markets has been accelerating since summer. They're not preventing a crisis. They're managing one that's already underway. This time, the Fed is trying to get ahead of it. That's what the new reserve schedule is about. They're trying to see the cracks before they become breaks. But visibility doesn't fix the underlying issue. You can force banks to report their problems faster, but that doesn't give them more reserves. It just makes the problem more obvious. And once the problem becomes obvious, confidence disappears. And once confidence disappears, the spiral begins. Right now, the market is calm. Treasury yields are stable. Stock prices are holding. The VIX is low. Everything looks fine. But that's the surface. Underneath, the Fed is scrambling. They're adjusting schedules. They're injecting liquidity. They're watching the reserve data like a patient on a heart monitor. And when the central bank is watching that closely, it means the patient is sicker than anyone wants to admit. Here's what I'm watching next. If the Fed starts expanding repo operations again, if that $17 billion becomes $30 billion, $50 billion, that's confirmation. If banks start reporting reserve shortfalls under the new schedule, that's confirmation. If the Fed quietly rolls back some of the quantitative tightening, that's confirmation. All of those moves would tell you the same thing. They're losing control of the liquidity situation. But here's the thing about control. Once you lose it in a monetary system, you don't get it back by writing new rules. You get it back by flooding the system with money. And if that's where this is headed, if the Fed has to choose between letting banks fail and printing more reserves, we all know which option they'll choose. They'll print, they'll inject, they'll backstop. Because the alternative is a financial crisis, and the Fed's entire mandate is to prevent financial crises. So the new reserve schedule isn't really about managing liquidity, it's about buying time. It's about creating the illusion of control while the real problem festers underneath. And the real problem is simple. The system is running out of slack. The buffers are shrinking, the margins are tightening. And when a system has no slack, the smallest shock becomes catastrophic. I'm not saying the crisis happens tomorrow. I'm saying the pieces are moving into place. The Fed is changing the rules because the old rules aren't working. Banks are scrambling for reserves because reserves are disappearing. And the public has no idea any of this is happening. Because it's all happening in the footnotes, in the repo data, in the overnight lending rates that no one watches except the people who know what they mean. This is how it starts, not with a bang, not with a headline, with a schedule change, with a technical adjustment, with a $17 billion liquidity injection that gets classified as routine. And by the time it stops being routine, by the time it becomes a crisis, everyone can see the damage will already be done. So watch the reserve data, watch the repo operations, watch how often the Fed steps in to provide liquidity, and watch how much they provide. Because those numbers don't lie. They can't be spun. They can't be managed with press releases. They're the raw signal of a system under stress. And if that stress keeps building, the new reserve schedule won't save anyone. It'll just give us a better view of the collapse as it unfolds. Stay alert.